All right, everybody. Thank you so much for joining us today. Jamie and I are so excited to show you guys our Detroit 61 unit portfolio that we have going on here. So let's get started. First, a little bit of a disclaimer. This document is not an offer or solicitation to purchase securities. It provides information about existing locations, projects, financing, and similar items, making statements based on this analysis of information believed to be true. However, these are opinions and prospective investors must conduct their own evaluation of the information. The document provides projections and should not be construed as assurances, promises, or guarantees. This fundraising deck is for informational purposes only and does not constitute an offer or solicitation to sell shares or securities. The content is based on information currently available and may be subject to change. Projections and forward-looking statements are subject to inherent risk and uncertainties, and actual results may differ materially. Recipients are advised to conduct their own due diligence and seek professional advice before making investment decisions. No representation or warranty, expressed or implied, is made regarding the accuracy or completeness of the information, and the creators disclaim liability for actions taken based on its content. The document is confidential and should not be reproduced or distributed without the creator's consent. Nothing in this document has been reviewed and or approved by the SEC. Okay, with that out of the way, let's jump right into it. So this is the objective of our Revolution Capital. Our mission is to help our investors generate cash flow and build generational wealth through commercial multifamily real estate investing. Typically in multifamily investing, you have funds that try to maximize returns, or others that try to prioritize minimizing risk. At Revolution Capital, we aim to achieve both by focusing on the speed of execution. Our idea is to return your investor capital as early as possible so that you get your money back, anything you invested back, and we pay you a pref rate in the meantime when we haven't returned your money. After we return your money, what a lot of multifamily syndicators do is they will kick the investors out of the deal because they've returned your money. But that's not how we operate and not what we believe. We believe in a true partnership where because you've invested with us, we keep you in the deal and we all get to enjoy an infinite cash flow after you make your money back. So you can potentially put your money to use with us again or elsewhere if you like. So just a quick background about myself. So my name is Wang. I'm classically trained as an engineer, but I currently work in the pharmaceutical industry. I've seen a little bit of success as a chief scientific officer of a small medical device company where I helped the company double revenue in the midst of COVID. My next endeavor, as you might have guessed, is that I have my eyes set on real estate. And I'm really looking forward to exploring all the opportunities that are available out there. In the past 6 months, I've acquired 3 properties totaling 7 units. And obviously my current project is this multifamily deal that I've partnered with Jamie Leclerc, my partner, to take down. And now I'll let her introduce herself. Jamie?
Thanks so much, Wang. My name is Jamie. You can't see me except for my photo on the screen, but that's okay. So my name is Jamie Leclerc, and I've been in real estate now for about 5 years, almost going on 6. And in the last handful of years, I've been very, very busy. I'm a motivated person. So I have amassed 11 properties across 3 states, Pittsburgh, Pennsylvania, Ohio, and Michigan. And that comprises about 46 units. I also have a property management company, Lipstick Properties, that does short-term, medium-term, and long-term rentals and an event hall as well. So I'm very, very familiar with property management as it pertains to all types of residency and leasing up. Additionally, in the last 1.5 years, I started a construction company, and that's Over the Moon Development Incorporated. And since summer of 2022, we have done just around $765,000 in rehabilitations across my properties. And now I'm very excited to take my property management company and construction company to assist other investors. And that's how Wang and I came together on this deal. So we're very excited. Also, I should mention that the majority of my properties are here in Michigan, in Metro Detroit, and I have extensive familiarity with the municipalities, with regulations as it pertains to certificate of occupancies, inspections, and that type of information. And so we are now working together to take down the 61 unit portfolio in Detroit. Thank you.
Perfect. Thank you so much, Jamie.
Mhm.
All right, let's dive into the meat of the deal. Here we go. This is the executive summary of the Detroit portfolio. So Revolution Capital is pleased to present our flagship investment opportunity. Our 61 unit portfolio comprises one 33 unit apartment building that was built in the 1970s. That's the Lenore building. We have two nearly identical townhomes over on Schaefer Highway, built in the late 40s and early 1950s, and 6 duplexes over on Lasser Road. The units are in extremely great condition. They command an average rent of $850 per unit, greater than 95% occupancy. And the biggest draw, I think, for us is that more than half the tenants are Section 8. For those of you that don't know, Section 8 is a federal program that where the government subsidizes low-income housing for low-income families, the elderly, and disabled. The nice thing about Section 8 is that the income is pretty much guaranteed. So our business plan is to go in and apply for rent raises on the anniversary of our Section 8 tenant renewals. The rents at $850 right now are currently well below market rate. Websites like HUD User, which is a federal website, or MISHDA, the local Michigan Housing Authority, cite rents as high as $1,291 per unit for 2-bedroom units, which is the majority of the units in our portfolio. And the seller has demonstrated $1,000 per unit on some of the units that he rented in 2023. So this is just a very low-hanging fruit for us to increase rents. We're also identified some major items through our due diligence, but we plan to do those in the first year as well. So one includes the parking lot for the apartment building and the roofs on the duplexes. But overall, again, the apartments have been kept in good shape, and there's minimal deferred maintenance. Our overall capital expenditures on rehab is only $320,000, which is about 10% of the purchase price. Here are some key investment details, investment highlights. So as I mentioned previously, we really believe in getting investor capital back as soon as possible, so that it de-risks the long wait time that a lot of other syndications and multifamily deals might feature. So we have an infinite cash flow model, meaning that after you make your money back, you continue to make money on the back end. So we target 100% return of capital by year 3. Something unique that we're offering as our flagship asset is that we're charging no asset management fees. A lot of funds and syndications will charge a fee to manage the money they raise. We're not charging anything here. Our debt strategy, we're pursuing a bridge loan at 75% LTV, loan to value of the purchase price. And we will have 100% of our capital expenditures budget covered. Now, the downside is that the interest rates might be a little bit higher than a conventional loan, but this allows us to refinance in year 2 into a permanent loan, and get our money back through the value add that we can pay you investors back. In the meantime, while you're waiting, we'll be paying out a 10% preferred rate on all the money that you invest per year, and we'll keep paying that until we return your capital. And with our conservative underwriting, we see a 3.4x equity multiple in 10 years. And the reason that the timeline is so long is because the property cash flows so well. So the longer you hold it, the more money you get back. And in fact, there are 2 metrics for determining a return. One is the internal rate of return, or IRR, and the annual rate of return. Typically, these 2 are not directly comparable, but when the IRR is higher than an ARR, it means that an investor can expect to get their money back much sooner than in the case where the IRR may be lower than ARR. About the asset, as I kind of mentioned, we're targeting Class C plus multifamily Section 8 apartment buildings, duplexes, and townhomes. And in terms of the investment, we're looking for a minimum $25,000 investment. We prefer accredited investors, but if you're not accredited, we can discuss in further detail how you might be able to invest. The total raise amount is $899,000 or pretty much $900,000. And then we plan to do a long-term hold after the refi event in year 2. Distribution, we'll plan to distribute the funds quarterly. So as soon as you invest with us within the first quarter, you should expect to see returns because we're purchasing a relatively stabilized cash flowing property. And again, by year 3, you should expect all of your money back and continue to take advantage of the infinite cash flows on the back end. And so here's a projected table of what the returns might look like if you invest 100K with us for easy math. So if you invest 100K with us, year 1, with conservative underwriting, we'll be just shy of the 10% pref rate. So we'll pay you about $9,400, and anything that we don't pay you will be deferred as a credit into following years. In year 2, if we've done our job, we've brought the rents up on the Section 8 tenants, and we've done the cosmetic rehab as well as fixed the parking lot and the roofs, we should be able to perform a refinance. And with a conservative 9.5% cap rate, we should get 80% of the capital back that will be able, and we get that capital back through the value add that we've done, through the rent raises and the CapEx. So then we'll be able to return most of your capital. And again, this is very conservative. We might be able to, there's a good chance we'll be able to return 100% of your capital within year 2. So at the end of year 2, we'll make a decision. Does it make sense to continue to hold it for the infinite cash flow? Or if we get appraised at a really, really great value, we may just exit the deal and return your money back and we'll split the profits. So think about that. Typical syndications, you invest your money and you might see a double up in 5 years. Here we're investing and we're getting your money back immediately within year 2 and collecting on the profits. So then in the event that we don't exit in year 2, we'll continue to hold the property and we'll continue to pay you out 100% of all the profits until you get your money back. And after you get your money back, that's when we begin to make money. That's our philosophy here is we don't make money until you make money. You make all your money back and you're on top of your pref rate. So eventually we'll continue to hold and give you cash flow. And if you look at here, if you invested 100K with us, year 4 through 9, you can expect between $13,000 to $17,000 a year on your $100,000 invested. And again, keep in mind, this is after you've already received all of your money back. Finally, on the back end, if we exit the property or if we do a refinance anywhere in between, you'll still get to take advantage of the 50% profit share. And so here's a graph of what the return might look like. In year 2, you will get your money back and it will cash flow. And then finally, there's a Christmas bonus at the end. So here I'll turn it over to Jamie to talk about why invest in Detroit.
Thanks so much, Wang. You do such a great job talking about all the statistics and on these particular properties. And I just want to talk a little bit more about Detroit. Why Detroit? And I just want to say in the last handful of years, I've become very familiar with the investor community in Detroit. And this is not surprising because of the incredible recovery and rehabilitation that's occurred in the city. We have really big investors coming in and putting in a lot of money into new construction, into restoring Detroit. We've got Chase Bank and a lot of large amounts of investments going in. Additionally, this is a fantastic rental market. You have a tremendous amount of cash flow coming in. People have a need for housing and the demand is significant. Thanks. Yes. So as a lot of people have probably already heard, we've had tremendous growth in Detroit, lots of investments from bigger people. Ilitch, JP Morgan and Chase put $200 million into Detroit, and the jobs are just plentiful. If you look at that chart in figure 1, you'll notice that even during COVID there in 20, there was a small glitch in manufacturing jobs, but the rents have continued to go up. Vacancy rate has gone down, and Detroit has just become a prime area for real estate investment. So this area that we are in is not downtown Detroit, but in a very, very good area, just outside of Dearborn, where there's also a lot of development going on with, Henry Ford, buying up a lot of real estate and putting a lot of money into their, jobs and making, also housing for people. And so this area is actually a prime area of Detroit where the neighborhoods are very well kept. They're, nice houses. They're in good neighborhoods. So so we're, in terms of safety, in terms of people staying here long term, it's just a very attractive location to live. You can go ahead. Thanks. So why multifamily? Obviously, if you're sitting on this, if you're listening to our presentation, you're interested in multifamily. We have a good working understanding of stable cash flow. When you're investing in multifamily, you have the ability to stabilize, because if you have turnover, you have units go vacant. If you're in the multifamily real estate world, your vacancy doesn't is stabilized by other rents coming in. So there's more stable cash flow. Instead of, if you have a single family property, somebody stops paying rent, you've got 2 to 3 months before you can get them out with eviction. And so it takes a little bit of time to get your cash flow back. You have incredible economies of scale. If you're investing in multifamily, you can replace a handful of furnaces or maybe a boiler or two. And you don't have to replace a furnace in every single home that you're buying. Also, as it pertains to property management, the per unit cost is actually much lower, because again, you've got economies of scale. Diversification is also a big one. We can be diversified as it pertains to tenants, and we can attract a wide variety of people to live collectively in a multifamily building, which also helps with the stabilization. And then, of course, growing demand. You got a lot more people these days that are looking to live in more collective societies and living close to each other. So we have a result of higher rents, lower vacancy, and higher property values. And why Section 8? I do want to take a minute and talk about my history just for a split second. Before I started my company in 2017, I had worked for an affordable housing developer in Troy, a company called Community Housing Network. And I had worked there for over 10 years, and we worked with Oakland County, Macomb County, Wayne County, Section 8 agents, MSHDA, Michigan State Housing Development Authority, and also HUD. And the benefits of Section 8 are honestly tremendous, both for tenants and for property owners. Number one, Section 8 is remarkable and wonderful because it's stable government-backed income. For people that are low income, Section 8 is a blessing. They are able to pay 30% of their monthly income towards the rent, and then Section 8 pays the remaining amount. They subsidize it. And so the landlord will appreciate money's coming in even when the tenant has trouble. So if the tenant ever loses their job or their income changes, they file a change of income with their agent, and the rent adjusts according to the income in the household. So it doesn't matter what the income is. The property owner continues to enjoy stabilized rent that's government backed. Obviously, because of the government backed income coming in, you have reduced vacancies and optimal occupancy. And the truth is, when a family in a household has a Section 8 voucher, it's a huge security, and people value that. They do not want to lose their Section 8 voucher. So they tend to stay, they tend to take care of their place because they don't want to lose their voucher. They tend to follow the rules of the program. And so it's highly valued by them, and they want to take care of their unit. So they stay and they continue to do what they're supposed to do. Additionally, Section 8 supplies a steady flow of tenants, again, minimizing your downtime in between, and your vacancy rate is is lower as a result. With every Section 8 contract, you have to have a 1-year limit, minimum 1-year agreement with them. Again, ensuring consistent cash flow, mitigating the impact of those market fluctuations. During COVID, you may be interested to hear that MSHDA paid 100% of all Section 8 rents, regardless of their income. That was across Detroit and Michigan here during COVID. So even in that time of crisis, anybody who had a Section 8 voucher was collecting sustained rents the entire time. It was backed by MSHDA. So, and lastly, you get from that risk mitigation and investor protection, government oversight ensures compliance. These people don't want to lose their vouchers because it's their security. It's a guarantee to have housing, safe, affordable housing over their heads and their families' heads. So they do follow the rules, and they tend to take care of their place because they don't want to lose their voucher. It adds an extra layer of protection for the investors, and it also leads to better maintenance of the property by the tenant themselves.
Got it. Well, thanks so much, Jamie, for giving that thorough and detailed background on Section 8. And as I'm sure you can tell, Section 8 sure sounds like it has a lot of benefits, both for the tenants and for investors, right?
It certainly does. And when I worked with at the affordable housing developer, we worked extensively with the Section 8 agents and the housing commissions across Metro Detroit. So Lipstick Properties already has a background that's rich with knowledge and experience working with Section 8 as it pertains to inspections, recertification, lease up, the whole 9 yards. So it's something I'm already very familiar with, and a bit of a bread and butter, if you will.
Amazing. All right, let's look at the properties, shall we?
Yeah.
So here's the executive summary of the properties. Again, it's a 61 unit portfolio located on Lenore, Lasser, and Schaefer. It's highly occupied, around 95% occupancy, and they're in close proximity to each other. Here's the Lenore apartment building. Here's the aerial view and the side view, the street view. It's 33 units, built in the 1970s, 23,000 square feet on I think 40,000 square foot lot, 94% occupied, and over 300K in gross effective income. Here's the townhome, the first set of townhomes. It's 8 units from on Schaefer Highway, 8224 to 8252. Built in 1955, 6,700 square foot, so around 850 square feet per unit, 95% occupancy, and nearly 90K in income. The 8290 townhome is nearly identical to the other one. And again, you'll see similar statistics with slightly lower gross effective income. And finally, we have the duplexes. These are the 12 units over on Lasser Road. And I forgot to mention the townhomes, the tenant pays for gas and electricity, not water, but in the duplexes, the tenants pay for all utilities themselves, which means that on top of the gross effective income, the NOI is extremely high. Net operating income is extremely high. All right, so let's go into it. What's our strategy to do that value add so that we can when we do a refinance, we can have a good appraisal value so that we can get the money back and pay our investors back. So here's the investment strategy. I've alluded to some of it previously. So typically when you invest in multifamily, you have 2 main levers you can pull. One is cash flow and one is appreciation. And I'll start with the latter. In appreciation, you buy a property and the property may not generate a lot of money for you. But if you hold it long enough, the property will appreciate and you will be able to sell it for a lot more money. Sometimes you can do what's called forced appreciation by performing heavy value adds or making extensive repairs on a distressed property so that the property is forced to appreciate and then you might exit. So a typical syndication model is somebody might buy a distressed property and they'll fix it up and they'll sell it in 5 years and return you that money. On the flip side is cash flow. There are properties that, like the one we're investing in, it may not have significant appreciation like some other properties, but the ratio of cash flow to the purchase price is extremely high. In Detroit and the Midwest and the surrounding areas have some of the highest cash flow rates in the country. It's unmatched. And we're picking up our 61 unit portfolio at an impressive 13% cap rate. And the cap rate is actually only so high because the current property manager or the current owner property manages everything himself. And so we anticipated some of the expenses that will come in when we take over. And so even upon takeover, we'll have a 10% cap rate, which is, again, extremely high for this property. So here are some of the numbers I presented previously. The units currently command $850 per unit. Average rents with mostly Section 8 tenants. And again, Jamie touched upon why we like Section 8 tenants. And with fair market rents at $12.91, we have a ton of upside with minimal work. So again, it's a very low hanging fruit to just go in and apply for those raises. So Jamie will talk a little bit about the part 2 of the strategy on what do we do when the tenants are not Section 8.
Yes, thanks so much, Wang. So in terms of the renovations and the upgrades to the property, we're anticipating, I think 6 to 10 units per year that we're going to be turning. When those individuals exit the units, we're going to be performing minor cosmetic rehabilitation that will include new flooring, paint, upgraded kitchens and bathrooms. My construction team is very, very seasoned. We've turned in, I think, almost 34 units in the last couple of years, and we tend to get in there really fast and turn those quickly. So after we upgrade those units, we're going to be charging close to $1,050 a unit. And then also we're going to be doing a few other things. So at the 33 unit, we are planning on cleaning up the grounds and adding taking care of the parking lot. That we definitely want to do that around the 33 unit building, and that will add a tremendous amount of value, as well as upgrades to units. And we'll also be doing some cosmetic improvements in the common area, and giving it a much doing a refresh on the property and making it look brighter and more inviting. After we complete those renovations, we're going to be doing a refinance in year 2. And at that point, we aim to return 100% of your capital on top of the 10 pref per year. And we're anticipating that between year 2 and 3. So when we do complete that, we'll return your investor capital 100%, and we'll be cash flowing tremendously well. At that time, we're going to hold the property indefinitely, and even though we're refinancing and we're returning your capital, we're inviting you to stay in the deal with us, and we continue to split at 50-50. So it's truly a partnership. Wang and I are dedicated to our investors because we want to do this over and over and over for you because we love what we do. Absolutely. and we want everybody to appreciate these returns. So not only are you going to share in the future cash flow, you're also going to share in any proceeds derived from the refinances and exit events. We are going to deliver on all of our promises as GPs. We are certainly going to take these units. We're going to make them very nice. We're going to be raising rents, and all of you are going to be able to enjoy the returns from that. Oh, and then did we forget to mention no asset management fees? We do not charge any asset management fees. So you as the investor will receive 100% of your invested capital, enjoy 10 pref returns, and then after we refi, we even go higher than that. So we're really looking forward to working with you guys, and we've made this, we believe, very attractive for that reason.
Yes, couldn't agree more.
Yes.
Okay, so let's cover a little bit about our mission. So obviously our mission is our duty first and foremost, excuse me, is to take care of you, our investors, but we also have a duty to the residents. You know, we want to make sure they're treated with dignity and that they find joy living in one of our properties. We're not in the business of being slumlords, and we want to make sure our properties are kept up and in tip-top shape. And in fact, this was the legacy of the current owner. We think he did a very good job keeping up with the properties, although there are some minor items that were deferred. Most of the stuff he has kept up with. In fact, in one of our inspection reports that we got back, almost everything was above average. We only had one item which was below average, and that was the parking lot in the apartment building, which we've planned for in our CapEx. So here's an extensive list of some of the things that of some of the updates that the owner kept up with in his 7 years of ownership. He replaced the roof in the apartment building. It's just 2 years old. Replaced the parking lot gate. Replaced a lot of windows, hot water tanks. These are major ticket items that Jamie can tell you will cost a lot of money if it was deferred and we had to come up with the money to do that work, right? Okay, so we've already covered a little bit of the investment details, but let's dive it into a little bit further. Here are some of the fees that we have to disclose that we will charge. One is the acquisition fee. Typically, this is a % of the purchase price that syndications will charge, and it ranges from 1 to 3%. We've kept it on the very, very low end of 1% so that we can pass the savings on to you, our investors. As we mentioned, because this is our flagship investment opportunity, we wanted to really make it attractive for our investors. So we'll be charging a 0% asset management fee. Again, the industry standard is 1 to 3%. As Jamie mentioned, she has, her Over the Moon development property and Lipstick management property, our Lipstick Properties management company. And so we'll be charging 7% of the rents collected and 10% of the projected costs of construction. And to give context, the typical fees are 8 to 10%, if not more, for rents collected. I've seen as high as 12% recently, and 15 to 30% of the construction projects. So Jamie is extending all of these savings through her company to you, our investors. Finally, we have the refinance fee and we have the disposition fee. The refinance fee is the 1% of the refinance value of the property. We plan to, again, refinance in year 2 so we can get that money back and pay you guys back, our investors. And then on the back end, we plan to take a disposition fee at 1.5%. This typically ranges also from 1 to 3%. Here's just another, we presented this up front, but we just have it here again for your review. We moved it up front just so that for people who want to just have the 5-minute summary, they can see the deal, the highlights. Again, it's presented here, as well as the projected returns. Again, refinance in year 2 to 3, getting your money back and enjoying infinite cash flow on the back end. The other bonus that if you've learned a little bit about real estate investing is the bonus on accelerated depreciation. This is a complicated topic. I don't want to spend too much time on it. But in short, under President Trump's presidency, he passed the Tax and Jobs Relief Act that one of the stipulations was from 2017 to 2022, properties were allowed 100% accelerated bonus depreciation. That means you could take 100% of the depreciation in year 1 of when you acquire the property. But sadly, that's slowly going away by 20% per year. So in 2024, the accelerated bonus depreciation is only 60%, but that still would allow us to get $400,000 or $475,000 of paper losses, which equates to around 50% of additional tax savings for you. I do want to add here that we're not tax professionals, so please consult with your tax professional to verify the information. As with any investment, we've told you a lot of upsides and how attractive this deal is, but there's always anticipated risks and potential downsides. And here are a few that we have identified, but we do not believe to be significant hurdles for us. So one is potentially undiscovered deferred maintenance. As I mentioned, we've performed extensive inspections during our due diligence period, including a 500-page report on all the items. And as I mentioned, almost all the items were either average or above average, with several exceptionals. Only one item was below average, and that was the parking lot for the apartment buildings. The other thing that came up during due diligence was the roofs for the duplexes. The roofs are a little bit outdated, and one of the units was replaced by the current owner, but we'll have to come in and replace 5 of the 6 units. Obviously, you know, things do break over time, and there may be other things that could have been missed, but we'd like to believe that we were extremely thorough with our due diligence in identifying these risks. Another potential risk is the longer than anticipated vacancies after rent raises. As we kind of mentioned, our plan is to perform rent raises on Section 8s. As Jamie talked about, the nice thing about Section 8s is as long as the government approves your application, you're free to raise rents, making it a very low-hanging fruit to achieve that rental increases. But we do face a risk when it comes to cash tenants, because as you raise rents, as you can imagine, some tenants might not want to pay those higher rents. So they'll leave, and that gives us the opportunity to perform the cosmetic rehab so that we can rent it out for even higher value. However, those at the higher rents, it may potentially take longer for the new tenants to apply and be placed in the new units. So occupancy rates may remain low for a little bit, but we don't anticipate that, again, to be a huge issue. And part of that comes from the diversification in terms of the types of tenants, the types of units, etc. Finally, a potential risk is delay in the refinancing out of our bridge loan. The bridge loan is nice because it allows us to purchase a property with a high LTV and fund 100% of the capital expenditures. However, the downside is that the rates are going to be higher than what a permanent loan might be. Our plan is to refinance in year 2, but if that ends up taking longer than anticipated, we may be stuck in the bridge loan for a little bit longer, meaning it'll take a little bit longer for you to see that return. But we don't anticipate it on the time scale to take, you know, more than double, maybe a few months, maybe like 10 or 20% extra. So it's a risk, but it's a small risk. Finally, is this fund right for you? This fund might be right for you if you are an accredited investor with focus on building generational wealth. Again, as I mentioned, we are open to considering taking non-accredited investors, but we can touch base offline if you're interested and you're in that situation. This is right for you if you're looking for early returns on your capital. Again, compared to some traditional syndications where you have to wait 5 years to see, you know, a lot of your money back, we get your money back immediately, and you get to continue to see it over the course of investing with us. This is a truly passive, hands-off investment, and you'll be generating infinite cash flow. And as we mentioned, you know, it's limited in risk because we have diversified types of units as well as tenants. And there's the bonus write-off from the accelerated depreciation. So if you're interested in investing with us, we are in the process of setting up our fund through the company we've decided to partner with, Avestor Inc. And maybe Jamie, you can talk a little bit about the fund.
Sure, yeah. Okay, so the fund focuses on picking up properties at a reduced amount of money that will require some upgrades and forced equity. And we specialize in improving properties and then you know, increasing the income in those units and really trying to find the highest and best use of those properties so that we can maximize the returns. Our particular fund emphasizes also stability. We like to go into investments that have good cash flow, but there is an opportunity to increase the equity via upgrades in construction rehabilitation. So the model is very clearly defined here. We've got a good history of over 15 properties where we bought them, improved them, increased the return substantially, and then exited into a long-term refinance hold time. And it has served us tremendously well. So we invite you to peruse and become familiar. This particular investment is our biggest investment so far, 61 unit portfolio in Detroit. And truthfully, we're inheriting it from an individual that's looking to retire, who's taken very good care of these buildings and of these units and of these tenants. just a side note, when we went to do inspections with him, he knew every tenant by name for memory. He knew
Yes.
every single one of them. So, Lipstick Properties is also very responsive, and we very highly value customer service. We take care of our people. We are very quick to respond and remedy any maintenance requests. And we pride ourselves on the quality of our work, the professionalism of our contractors. And I have a very good strong team to support the demands of the 61 units. So we're excited about this. So LCE fund is carries that foundation of adding value, strong customer service, transparency, and taking care of our investors first and foremost, and of course our tenants. These are their homes, and we want them to appreciate their home. So come check us out at LCE Fund on avesterinc.com.
Thanks. Yes, definitely. And I should just quickly add that with this 61 unit portfolio, you can invest through LCE Fund, but you can also use LCE Fund in the future to invest in our other projects that we're very excited to share with you. We have a couple things in the works that are coming for 2024. So keep your eye out for that.
Woohoo!
Finally, just some facts here. I'm not going to spend too much time on this page just because it covers a lot of the information that we've already went over. And, if you're ready to invest, please feel free to reach out. Here's our contact information, our emails, and our cell phones. And I just want to say, we appreciate you for your time. Thank you for joining us.
Thank you very much, and looking forward to working with you.